Okay,
and I was being jokey at your expense earlier. I said, "Where's Batman?"
Where's Batman?
Or Ball.
Okay, here we go.
All right.
Welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hanf of Pacific Private Money, one of California's fastest growing mortgage investment firms, and Lou Botmal of LPL Financial, who is on the phone today. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right. Actually, 3 vacations during this show. That's how we're doing it. And we're giving vacations out by Lighthouse Resort and Marina because the radio station is not sponsoring the vacations. And their only request, a $75 cleaning fee to cover the housekeeping expenses. Today's trivia theme is Pigskin Challenge.
Nice.
All right. Our website is bestofinvesting.com. And Lou, start off with us. I know you wanted to talk about what was going on with year-end portfolios and all that.
Well, there's a couple things you might have to pay attention to this time of year. The first one, probably most importantly, is for those in taxable accounts who look at tax loss harvest, which is a function of selling off losses you have in your account to offset any gains. So people aren't aware that ETFs don't usually have pass-through gains in their portfolios. So if you have a loss in the ETF, like many bond ETFs have lost this year, you can't sell them at a loss and take off any possible gains you have in the equity side of your portfolio. So you sell something that has a winning number this year off a loser this year, and it offsets $1,000 loss, offsets $1,000 gains. You have to get taxes. Capital gain rates have gone up in California. It's a little bit of a challenge. We recommend everyone check their portfolios and look for any possible losses to offset some of the gains you have. If you have mutual funds, many people are not aware that mutual funds buy and sell throughout the year. If they have a positive year, sometimes they'll distribute gains to people this time of year. So you might be getting communication from your mutual fund company that gains are coming that you weren't aware you had. And some of your funds might be net neutral for the year. They might be the loss. They might be the gain. They still distribute gains. You want to be careful this time of year looking at that specifically.
Yeah, that's a good point about the mutual funds because a lot of times people have everything just reinvested. They don't think about it, and suddenly they get this 1099 with a large gain on it.
Correct, and a lot of funds that I watch, and managers that I watch, Edward Mark, were considered to have gains back in April of this year earlier, maybe in June. Through the August downturn, people sold and repositioned a lot of stocks too. So you have to be really careful. You really don't know what's going on with these funds until the end of the year or this time of the year when they're sending you notices talking about these taxes.
And do you suggest that people call their broker or the mutual fund itself, or just wait to get that letter from them saying get ready?
Want to be proactive. We're in the first week of December, and I recommend everyone contact their investment professional for year-end planning, or maybe even talk to your CPA about previous years and what's occurred. How you can offset those. Another thing to look at is everyone looks at their investment portfolio this time of year and say, how should I be investing? The equity side of the market, for the most part, is better than the bond side of the market this year. So people are looking, how do I reposition? We're headed into some interest changes possibly as soon as the next couple of weeks, and maybe throughout all of 2016. So I'm talking to clients about how much risk you want to take versus how much bond risk versus equity risk. Bonds usually will go down in value. Bonds do go down in value as interest rates are changing. Everyone's focusing on the tough bond market right now. When you're looking at a portfolio, discuss the amount of risk you want to take. Reassess where you are now and where you think you want to be at the end of next year. And maybe you want to take some gains in the equity side, or maybe you want to take some bond positions off. But like Edward, like you said, the good thing is to talk to your investment professional and say, what should I be doing right now? How should I be assessing my risk? And what should I do going forward? It's an important conversation at the end of the year. You have a few down hours when you're not shopping, you're not taking care of family, or you're not cooking. It's time to look at your portfolio. That's what we do this time of year usually.
Well, Marshall, want to chime in?
So should this be a surprise, Lou, to anyone who's been investing? Or what's maybe different this year in 2015 that maybe they might not have experienced with similar investment portfolio in prior years?
So what's different this year is a great question. Is that the bond market really had a flat to negative year. Most bond classes, high yield bonds have done very poorly. Floating rates done okay, but by and large, treasuries and other bond funds have had a real struggle and had some negative returns. And with that, we're seeing people know, well, bonds are a safe investment. And we had this August time period where assets really went down in value. And everyone goes, oh, I'm going to go back into bonds, but the bonds are giving you a yield of maybe 2% or under. On an inflation-adjusted basis, they're not making a lot of money. Things are a little bit crazy, and people don't get it. The first time in 25, 30 years, bonds are having a net negative return.
Wow.
And you feel that you're that aftermarket, it hasn't happened in a long time.
Did interest rates change enough to cause those bonds to decline in value, or was there some other factors?
It depends what type of bonds you own and when they were purchased. So this year, yes, if you look at the bonds, if you invested in some bonds from last year, specifically high yield, you definitely have a losing year this year. Spreads have widened considerably in the high yield market. On top of that, normal treasury bonds have gone from about a 1.75% interest rate up to about as high as 0. So people who bought bonds last year, when that happens, you actually lose value in your bonds. So people don't see that erosion, and we have another year like 16, like 15, you see further erosion in your bond portfolio. Now, there is some good news. There's high yield, or there's municipal bonds done pretty well because they're tax-free. Both state and federal level, you buy California tax-free bonds for your listeners, which have done quite well. Some floating rate funds have done well, and some strategic funds have done well because they have a latitude to position the bonds where they see fit.
So the people who own muni bonds are saying, yeah, go real estate, go income taxes, go up and up and up.
Right.
Yeah.
You're exactly right. So it's a great year for that. You know, the bond story is all negative all over the lexicon, but what is negative is this interest rate forecast that we see coming down the pipe over the next 2 years. And there's just going to be an interest rate resetting of some sort. Let's see how that goes.
So Lou, you mentioned earlier about everyone. There's general expectation that the Fed will make the first of what's probably going to be many successive rate increases in the short-term rates. But there's a lot of mixed opinion out there about how it's going to impact long-term rates throughout much of the beginning of 2016. Do you have any thoughts on that?
That's a great question. So I think we talked about this before in a previous show, or I think I heard it in your program before. That the Fed really controls the short-term or overnight lending rate between banks and institutions. They don't control the 10-year bond. The 10-year bond is more of a confidence barometer for where people think interest rates are going to be. And some have said, yeah, if interest rates go up 75 basis points by the Fed and making those changes over the next year, then the 10-year is going to be 3 or 4%. We really don't know because the market sets that rate. You have to remember one thing too. There's a big incentive for interest rates not to go up because when they go up, it makes the government have to give more interest. And they don't want to do that in their 10-year bond right now. They can't afford it. So we're really interested in seeing, what part of the bond market will move one way or another. What's really interesting too is global bonds, because of the strong dollar, have had a really bad year as well. So, government bond position, like you mentioned, the long bond, is going to be really fantastic up next year. And I don't know how much they're going to move, but we're watching it very closely. It's hard to say.
It is hard to say, and there's arguments to be made for those who are trying to predict this thing that we may still see mortgage rates, for example, hover at what's now 3.95, call it 4%. We may see the low 4% range well into 2016 before we start to see any significant movement upward, or the opposite might occur. You just never know with world events and all the other economic factors that feed into the 10-year mortgage rate.
Exactly, and again, it's a free market. Anything could possibly happen.
Yeah.
And, people kind of ride that wave because of the mortgage component or credit card interest rate components that are built into all those factors. But in the end, we really don't know what's going to happen. A lot of it's unconfident. And given the global position right now, people really like the U.S. dollar. And if that continues to happen, then you're right. Interest rates might not move much at all for the next 6 or 9 months. Don't forget that the European market's trying to do quantitative easing to try and increase their output. And just today they said they're probably not going to do as much as people want. So the interest rate gain, and so I can say, where do you put your money? It's kind of forcing everybody to a decision like take on risk or do I not take on risk? Is it better to own a high yielding stock than a bond right now?
And good
People
point.
are really stuck. If some stocks still pay 3% interest, what's better? That's what people don't know. That's why you should talk to their investment professional.
Yeah, 3% dividend on that. Yeah. So,
Right.
Lou, there might be. I'm sure there's going to be a lot of interested listeners out there who are going to want to ask you a lot of questions. I know you're pretty good about giving some free advice. How do they get a hold of you?
They can call me 415-256-8970. LOUIS, PATMALE. You can type it in, you get my website. You can email me or call anytime. We do return messages. We do talk to people about their portfolios, their questions all the time. We love doing it.
All right.
That's why we do this work.
Okay. I know you got to catch a plane. Stick with us as long as you can. We're going to cut to a commercial break, and then we'll come back. All right. So here's our first commercial break. The question has to do with Pigskin Challenge. The American Football League, AFL, played its first season in 1960 with 8 teams. Which team won the first AFL crown? The first caller with the correct answer wins a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer that question. Stay with us. You're listening to The Best of Investing, and we will be right back. All right. So let me write this down quickly.
Not bad, Lou. We did hear a little bit of
Just a little background stuff.
announcing in the background.
But it all did was sound, you just sounded important. You know?
Thanks. Exactly. No, sorry about that.
No, these things happen. Okay, hold on.
Yeah, our company actually just canceled the event going forward. We always did in December, and everyone's kind of complaining we just don't have time. Everyone's trying to wrap things up. So,
What else could we cover in the next segment?
but actually, if you wanted to, I could do like 5 or 6 minutes. You actually hear it. Many people can max out their 401k. Kind of
Okay.
those limits,
That'd be great.
the rates, and how they work. It's always good to do the year end, so I can do the first 5 or 6 minutes on that.
Perfect. Okay.
Perfect. All right.
All right. Let me get this file saved, and we are ready to go.
Okay.
All right. Here we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Lou Botmal. When we go to the first commercial break, we asked this trivia question. The American Football League, AFL, played its first season in 1960 with 8 teams. Which team won the first AFL crown?
No idea, Lou.
Kansas City Chiefs.
Nope. This would be George Blanda played with them, the
Raiders.
Houston Oilers.
Oh,
All right. Okay. So, Lou, give us some. What are you going to talk about? Some
Year-end,
planning.
All right. As we get to the last pay period for people, it's important for everyone to recognize that everyone usually gives their 401k deposits up to the amount that people match their
Yep.
401k by employers. That's great, but you can actually put more money in your 401k than the match. Up to $18,000 if you're under 50, up to $3,000 if you're over 50. The catch up to the contribution. You can sit there if you have enough money, you saved enough this year. You can put as much money of your last paycheck into your 401k as you possibly want to. And people forget that. And now's a good time to take an assessment and say, how much money do I need? Because every dollar you put away, you don't pay income tax on. Right, Edward?
That sounds pretty good to me. In fact, what they could do is if they've got a credit line in their house, and they said, "Well, God, I'd love to put my last paycheck in, but I need money," just temporarily borrow it off your, off your equity line, maybe.
There's a variety of ways to do it, and I think the important thing is people remember that you go over the limit, you don't have to go up to matching limit. These are vehicles set aside to have up to $18,000 put away, and then we have also the ability to put money into your IRA. IRAs limit $5,500. If you're over 50, it's $5,500. And the difference between an IRA and 401k that people don't understand is you have to fund your 401k by December 31st, not fund it afterwards. People forget that frequently. So this is an assessment you have to make today if you want to do it this year and talk to your administrative assistant in charge of payroll or at your company. So IRAs work a little differently. You can fund those up as you can file your taxes. The tax deadlines, usually April 15th, or it might give you a day or two extra, maybe April 16th or 17th the year following. You can put money into that and also save money on your income tax as well. But, you have to start budgeting now so you have that money later on. Most people forget about it. They file their taxes, they get your CPA or your tax professional or even surplus taxes, you put $4,000 in an IRA, you save $2,000 in taxes. Why wouldn't you do that? It's your money. Why not keep it? So I try to remind people this time of year, it's a good time to assess how much money you have, how much money you can save going into next year. And again, the IRA you can do after the 31st, but the 401k you have to do before the 31st. It's a very important component in 2 different vehicles. So I like people to that's what they can do. I have several clients that will put as much as they can last paycheck in their 401k. Truth be told, between you guys and me here on the radio, most administrative assistants in HR don't like doing this because they have to change it.
Yeah.
But it's an important tool. It's there for you if you want to use it.
Now you mentioned on the IRA, you can fund it in the following year up to when you file your taxes. Now, what if you extend?
No, you can't do it with extension.
So it's still
Only a SEP IRA you can. Or
So that's a great question there, Edward Marks. So the SEP IRAs for people who have 1099 or individual income, and those you can actually fund up to 25% of your earnings, and you can fund that when you do file your return, even on extension, like Edward just brought up, which is a great point. And for self-employed individuals or people who do consulting work, you're allowed to use a SEP IRA, which is a great tool and allows a bigger funding limit than a normal IRA for $5,500. If you make $50,000, you can potentially put like $7,500 into a SEP IRA if you want to, based on your business expenses and everything. As we always say, talk to your tax professional. So these are great tools as we get to year end. You know, the tax man cometh. All have to be prepared.
absolutely.
I know we're all waiting for something to come down the chimney, but you know, what we can control ourselves is what we pay in taxes. And that's why I encourage everyone to use a tax plan this time of year.
Well, and it does get confusing when you're talking about 401ks, and some people have solo 401ks or solo Ks.
Right.
There's IRAs, there's SEP IRA, there's traditional IRA, and it's a mismatch. It's almost like trying to choose a health plan nowadays.
Oh, God. Oh, please.
No, there's several tools, and you're right. They're difficult to navigate. Again, it supports the income. Employer-funded plans of 401ks. If you're your own employer, then you can do the SEP IRA, and then anyone pretty much can do an IRA. In most cases, almost all of them, you can't do a 401k and a regular IRA. That's an important component to remember. You can in some cases, but it's pretty technical, and most don't qualify.
Yeah, you don't get the tax deduction.
Yeah, 401ks get the higher amounts. I usually try and instruct my clients to maybe use that first.
Are you a fan of the Roth IRA?
I am a fan of the Roth IRA if you have the right income structure. People don't remember you have to have a certain income structure to qualify for Roth IRA.
Yeah.
Some 401ks do allow you to put money into a tax-deferred vehicle like an IRA and a Roth IRA at the same time. Fund half and half. Roth IRAs are great when you retire. They're one of the best tools out there. If you don't take a requirement of distribution, you already pay tax on the money. The money comes out tax-free. That's what I love about it.
Yeah, I always wonder if the Congress can change the rules later on and go, hey, you know what? There's a big pile of money out there that we can access. I know we told them that we weren't going to tax it, but we're changing our minds.
Well, and the thing about IRA, Roth IRAs, they're all tax deferred. It comes out tax-free. It's one of the unique cases besides 529 plans I can think of off the top of my head that allow that to happen. So it's a great boondoggle. People have a long time retirement time horizon to utilize. And we really encourage people that are under the age of 29 who think they're not saving enough just to put money in a Roth IRA, depending on their income structure. If that money grows, and it exponentially grows over 2 or 3 decades, it can be a lot of money to help you supplement your retirement fund.
Absolutely.
We all know the number one cost of retirement right now isn't just living, it's medical costs, which are all going up. And I went to a seminar today on medical costs, and wow, that prognosis is really scary me. The minimum American on average is going to spend between $7,000 to $8,000 on Medicare the first year they're enrolled. And that number is only going up, so it's really scary out there.
That's amazing. Hey, while we got you for a few more minutes, Lou, I wanted to ask you a completely different type of question. I'm starting to read a lot of articles in the publications about the so-called unicorn companies and their stock prices and valuations, and whether people ought to be cautious when looking at them, because it's of course it's very, very tempting when you start seeing these huge run-ups in valuations in these so-called tech unicorn stocks. Do you have any?
What is a unicorn stock?
It is a company that is worth $1 billion or more, and it's typically one of these newer companies that just launched and just went IPO in the last couple of years.
Like a Facebook type of?
Like
Right,
Facebook.
so Facebook before it went public, right? Or Facebook is about to go public. A great example, Mark, today was Uber. The current Uber valuation, according to Bloomberg today online, that it's worth more than 80% of the money companies in the S&P 500. Those are all pretty big companies that earn more money.
Wow.
So you're right. There are these unique tech or startup opportunities. If you look at a couple different vehicles out there, one comparison I do for clients, these are not stock recommendations, but look at the stock performance. You got LinkedIn, you got Facebook, and you got Twitter, right?
Yep.
You look at all three of those stock companies right now, Twitter's really having some problems because not producing enough revenues. LinkedIn took off and stayed off for a long time, and Facebook kind of collapsed because no one knew what the revenue model was. It's the great unknown that people like taking the risk on. You know, it's a great idea to jump in deep water as long as you know.
What's Facebook trading at right now?
What's that?
What's Facebook trading at right now?
I think it's at $94, $95.
Oh,
So it's done well for people who got in early.
It fell as low as $20.
Yeah, I remember that.
These are all historical stuff. These aren't soccer. I would say that the stock market over the last year, if you look at, we talked about the bond market, the problems there. Some stocks have really led or been the generals of the S&P 500, and with that occurring, their valuation gets called into question because they haven't pulled back at all. If something doesn't pull back, you really don't know what it's worth.
Gotcha.
And that's something we need to assess moving forward. And looking at your portfolio, you might own the S&P 500 other index type products. What drove those returns? That's what you should talk to your investment advisor about. What should I be looking at? Where's the next return going to come from?
Lou, before we cut out to our next break, we're going to let you go. But before we do, give out your information one more time in case people want to get a hold of you.
Sure. It's my phone number is 415-256-8970. And my name is Louis, and then Patmale. Type it in the computer and you get my website, louisbothwell.com. And no questions or call us, and we'd love to talk to you, free of charge to answer any questions you might have.
And you can also go to the Best of Investing website. I believe you're up there too.
Awesome.
All right. Thanks a lot, Lou.
Sure.
Appreciate it. Catch your plane. Be safe.
Bye.
Oh, good. At least we got him before he had to catch his plane.
That was Lou Botmall.
That's right.
Some great advice.
Okay, now before we go to our next or to our commercial break here, we have a little a promotion here for the Meritage Resort and Spa. Nice. Very nice place, and you deserve it. A luxurious getaway in Napa Valley. Love Napa Valley. Meritage Resort and Spa boasts world-class luxury. Stroll across acres of hillside vineyards, enjoy award-winning cuisine, relax in the estate cave as you pamper yourself at Spa Terra, or savor flights of Trinitas, I guess you pronounce it. Trinitas Cellars Wine. Meet your friends in Crush Ultra Lounge with 6 bowling lanes. That's my sport, baby. And sports entertainment. Make reservations now for special winemaker dinners. The holidays and masters and makers at Meritage.com. That's MERITAGE.com. And actually, it's pronounced Meritage, like heritage. So I've said Meritage, but it's actually Meritage. So check them out, Meritage.com. If you go on the website, beautiful place, absolutely gorgeous. Okay, let's see here. Here is our second commercial break trivia question. Again, we're talking Pigskin Challenge. Which team did Hall of Famer great Johnny Unitas retire with? The first caller with the correct answer wins a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. So if you remember, Joe Montana played for the Niners.
Yep. But
then who did he play for afterward? Kansas City Chiefs.
Mm-hmm.
So Johnny Unitas, we all know who he used to play for. Who did he retire with? Stay with us because you're listening to The Best of Investing. When we come back, we've got some very interesting real estate to talk about with Mark Hunt, president of Pacific Private Money. Okay. Yay.
Oh, we're perfect. We're good on time.
We always like to be perfect, don't we, Kramer?
Absolutely.
Come on, baby. Come. Okay, the question we had for you was, how often do you have too much money pouring into your fund where you can't deploy it fast enough? If I were just happen to be talking about that.
Yeah.
All right.
Do we want to lead with that or just talk about?
No, let's get into first.
Okay.
You know.
Yeah, let's start talking. Let's get a little conversation going.
Okay, here we go. I'm going to make a mention here about Hornblower real fast.
Okay.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money. Lou had to catch his plane, so he couldn't be with us anymore. And let's see here. We asked a second trivia question about football. Which team did Hall of Fame great Johnny Unitas retire with?
I have no idea.
Okay, you remember who he played for?
Colts.
The Colts, that's right. But he retired with the San Diego Chargers.
Oh,
Right on the last part. Okay, and before we get back to Mark about some real estate stuff, I wanted to tell the audience, check out hornblower.com. They have special holiday cruises, Christmas Eve and Christmas Day, delicious dinners, live holiday music, and spectacular sights. You and I have gone on the Hornblower before. Very nice.
It's very nice.
Especially during Christmas time with all the lights and everything.
Absolutely.
You gotta check them out. Hornblower.com. Check out their holiday cruises.
Bring a jacket.
Bring a jacket, yeah, because when you go underneath the
Or
bridge,
two.
you go outside, it gets a little chilly.
Yeah.
Okay, Mark, so you are president of Pacific Private Money. We've been doing the show for 5 years. Things have been going extremely well.
Yeah.
And tell us a little bit about yourself and what's going on.
Well, the Pacific Private Money is what's known as a private money lender, formerly called a hard money lender. And essentially, we make real estate loans to people who are in a real estate transaction and they can't get or use bank financing. And, you know, funny, I had a conversation today, again, with somebody who said, why would anybody pay the high rates you guys charge for money? Well, first of all, what did she mean by that? Well,
Define high,
right. At Pacific Private Money, as with many private lenders throughout California, and certainly here in the Bay Area, the average interest rate we charge for our loans is about 10%. In other words, 10% interest rate as opposed to a conventional mortgage, which you can still get today if you've got good credit, for about 4%. And why is it such a disparity? Well, it's because it's definitely a different type of loan. First of all, people generally come to us when they have a very short-term or quick need to close. Oftentimes they'll come to us if they believe that they could get bank financing and then find out that they can't get bank financing in time and they want to make an aggressive move on a real estate transaction. And then there's people who just have really, hammered credit for any number of reasons. And they've got, they're just not going to be bank financeable. Now, the fact that we charge 10% versus say 8% or 6% compared to what the banks charge, 4%, is really a function of supply and demand. And because we use private individual capital who are using their savings or retirement accounts to fund the loans we make, it's really a market rate. And in fact, the market rate for private money financing used to be higher. It was, 12% was a pretty common amount to pay. And of course, when it was 12% 20 years ago, mortgage rates were 6 and 8%. So I will tell you that the spread, and I will agree that the spread between bank money and a private loan is higher today than it ever was in memory. So
partly because it's harder to get a loan at the bank. Let me go back for just quick, if you don't mind. One of the things you'd mentioned about people, let's say their credit getting hammered. If I'm the audience listening and I'm thinking, well, wait a minute, if their credit's hammered, isn't that a risky loan?
Well, it depends on how it gets hammered. So there's a lot of fine borrowers out there who have a short sale or a foreclosure or a loan modification, and that will hammer your credit. Another situation is we get a lot of people who have had health issues and didn't have health insurance, and maybe they had a medical issue, and they may have $100,000 or more of unpaid medical bills that even with a payment plan, those oftentimes will show up as bad debt on their credit. And then there's just situations for people who have been through a divorce and somebody who had control over the money or the bills that were in their name didn't make payments, and that's often actually pretty common too. So, but to talk about why anyone listening would care that there's a company out there called Pacific Private Money, and whether we charge 10% or 8% or 20% for money, why do we exist, and why would you care that we exist? Well, first of all, we serve two types of clients at Pacific Private Money. We provide quick, no hassle capital to people who need it quickly, and there's a lot of situations where you might need it quickly, and so we can save your real estate transaction. And you're paying 10% on the money, but you can pay it back as soon as you want to. There's no prepayment penalty. It's short-term money. But the second client that we serve are people who have money and that's a lot of people in the Bay Area, and they like to diversify their investment portfolio, and they'll have stocks and they'll have bonds and CDs, but they want to diversify into what's called the alternative asset classes that generally provide higher yields.
Well,
And so,
Well, especially with like what Lou was just saying, that people who had bonds thought that they were quote safe,
yeah.
and they were losing money because even if they earned 2 or 3% on the bonds, it dropped 5%. They were actually negative.
So more and more people have been learning over the last 5 years that there's this investment product out there that has safety and security features, yet you can get 8% or more on your savings by investing in what's called a mortgage-backed product, either a mortgage pool fund or investing directly in a note, which is oftentimes also called trust deed investing. So we have over 250 clients that have invested at least once with us over the last 8 years, and many of them are repeat clients, and they're calling us on a regular basis, looking to see what we have available to invest in, what notes we have available. We launched a mortgage pool fund 2.5 years ago, and that fund, in fact, we just did the November distribution, and that distributed just for 1 month 0.68%, so almost 0.7%. For the year to date, we're at an annualized rate of 8.17%. So again, a little over 8%. And these are on short-term mortgages that we're funding, week in, week out, to people. A lot of them are so-called bridge loans. Again, short-term loans for people who want to acquire real estate and intend to bank finance conventionally shortly thereafter. So again, it's if you haven't heard of mortgage investing, or you're interested in learning about what a mortgage pool fund is, or what note investing is, or trust deed investing. Again, it's a lot of different names that it's called, but at the end of the day, it's essentially using your money to help fund a loan, a real estate loan. And when I say a real estate loan, it's identical to the type of loans made by the banks, by Bank of America, Wells Fargo, Chase, Citi, or the other conventional mortgage loans. We use the same type of loan documents. We go through escrow. We get title insurance. The loans are virtually identical.
You're like a
to
mini bank. You're like a mini bank.
Well, we're private money mortgage bankers.
Yeah.
Is another term for who we are and what we do, because we lend the money that we control on behalf of our clients to people who come to us. And now I will say the one way that we are different from banks is that we're actually more conservative than banks in many cases, where you can get 80% financing typically on a transaction. In fact, if it's an FHA-backed loan, you can get up to 97% of the purchase price. We typically don't go over 70% of the purchase price.
Yeah.
That's, in fact, our portfolio of loans in our mortgage pool fund today is at 55% loan to value. That's the weighted average loan to value of all the loans in that fund is 55%.
That to me is
extremely.
that's conservative.
I believe it is.
Yeah, I mean that to me is the biggest part is your underwriting.
Yeah.
Which is why the default rate is very, very little, because who's going to default if you've got, to take the example that you're giving, 55%. If it's property worth $1 million and you've lent $550,000, how many people are going to walk away from that property?
Right.
Borrowers. It rarely happens.
I mean, there are risks, and we spend a lot of time every day and every week talking with potential clients about what those risks are, and we've got a very lengthy offering document that talks about how you can how the fund makes money, the types of loans it invests in, what are the risk factors. Nothing is risk-free, but I got to tell you that there are very few ways to make 8% on your money in this market that have the type of collateral backing that we have at the Pacific Private Money Fund.
Well, the conservativeness of the loans is almost to where when you make the loan, you're almost hoping the borrower doesn't pay,
Right.
because you can actually make a lot more money if they default.
So for more information on this, we do have we've got 2 websites, in fact. But the website for people who want information about mortgage investing or our mortgage pool fund, the site that you want to go to is pacificmoneyfund.com. 3 words, pacificmoneyfund.com. Go there, you can get some information online. Of course, if you just put your name and email address in on the first page, you'll get some information back in return. We've got a lot of information that we can send via email, easy to read PDF information that gives you all the details of how we make money at the Pacific Money Fund. And additionally, a lot of people come and visit us. We're located in downtown Nevada. We have
brick and mortar.
We're brick and mortar. We come in all the time. In fact, we're moving to our own building.
That's right.
Next year. We take possession January 1st. It'll be the Pacific Private Money building in downtown Nevada. It's formerly the home of what was Sonoma Bank before they got gobbled up by a bigger bank that got gobbled up by yet a bigger bank. And so we lease that building and we take possession. We start our tenant improvements in January. We hope to move in on or before March 1st, and we'll have several opening parties and events there. And so
Well, the nice thing is it's right across. It's almost right across from your old office, so it'll be easy to find.
Well, it's in the downtown financial district of downtown Nevada, where we're surrounded by Wells Fargo, B of A, Citibank, and Chase, and there'll be the Pacific Private Money Bank building.
There you go.
We're looking forward to that. It'll be really great. So we'll want people to come up, visit us, and you'll be able to see the brick and mortar and take some information away with you. And in fact, all the people that work at the banks around there all know of us. In fact, we get referrals from them.
Yeah, because sometimes borrowers can't qualify with them.
Oftentimes borrowers can't qualify. Hey, go across the street, see those guys.
Yeah, and in fact, Gil Gross has been doing some good advertising for you, and we've been getting a lot of new clients coming in.
Yeah, in fact, I heard his as I was driving in. I heard his radio show. Give yourself the gift of high yields. He's been saying.
That's a good Christmas
Yeah,
gift.
absolutely. So so again, go to our website. You can also call us too. Our number is 415-883-2150. 415-883-2150 for Pacific Private Money.
Great. Okay, we're going to cut to our last commercial break here. When we come back, we do have an email question for you that does have to do with when money comes in, how quickly can it get deployed?
How quickly can we put your money to work?
Exactly,
All
that
right.
sort of thing. Okay, let's see. Before we do, we have one quick mention here for Pacific Trade Exchange, and that's
Another Pacific.
Another Pacific, yeah, they're a business-to-business exchange. A lot of times companies have excess inventories, don't know what to do. What they can do is throw it into the barter system, and it's a good way to convert your excess inventory into, quote, cash. That could be used for other things. I've been using them for a number of years now, and very, very happy with them. Got to check them out at Pacific Trade Exchange. In fact, we're going to have Brian Capehart back on the show to explain a little bit more in detail. But if you're a business that is looking to get excess inventory, or you have some downtime and you just want to get more business, looking at these barter exchange, Pacific Trade Exchange is a very, very good idea. Okay, here is the last pigskin challenge question.
All right, see if I can get 1 out of 3.
Yeah, these are kind of hard, I gotta say. Rushing great Jim Brown played only in 9 seasons. He won an amazing 8 rushing titles. Who took the rushing title in the only season that Brown did not win? All right, the first caller with the correct answer wins a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. And that would be Jim Brown. Only played 9 seasons, and he won 8 rushing titles. But there was one season someone else won it. Who was that person? Stay with us. The Best of Investing. We'll be right back. Okay.
Are you related?
Don't know that one either.
To Jim Brown.
Jim
Yeah.
Brown, Edward Brown.
Yeah, we
We're
brothers.
blood
We
brothers.
brothers.
Yes, you
We
is.
all brothers. at
Yes,
the
you
core.
is.
It's like someone. It's interesting. I heard a question that someone said. You ever heard of Pangea? Basically, if you look at a globe and you go, "Hey, Africa
yeah.
kind of fits like this, right?"
Mhm.
And so they said, do you ever think at one point the continents were connected? And the guy says, well, actually, they're still connected. Because if you drop all the water out of the seas, everything's connected down at the bottom. And I go, that's actually true. But what they don't tell you is that they totally got rid of Central America and reduced Africa 40% in order to kind of fit the puzzle. It's like what I used to do, right? Take puzzle pieces, just take a hammer and just keep hammering until it works.
Pangea.
It's for all you evolutionists, creationists out there.
You're talking to the wrong guy.
Talking to the wrong guy?
I know nothing.
Yes. I still record the Hogan Zeros. I love that show.
Oh, that's great.
Jones.
Hogan.
Too bad he got brutally murdered, but other than that, it was good.
They ever find out who killed him?
They think it was the
They don't
guy who was in jail. Blah, blah, blah.
Lovely.
Okay, so that's his 22. This would be 36, 30. So this one's going to be 8 minutes and 36 seconds. Short one, 8:36.
It was Sergeant Schoss that killed him.
Yeah. He ate him.
They ate him.
Okay.
Oh.
Thank you.
Grabbing stuff.
This is good.
I love how you got tissues and all kinds of stuff. Holding that
Yes.
thing together.
Yeah, but it works. It works.
Yes, it does.
Okay.
Hello.
Just go back here. Ready?
Yep.
Ready, Kramer?
Ready.
It's hot in here.
Yes, it
That's
are.
nice.
Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money. When we cut to the last commercial break, we asked this pigskin challenge question. Rushing great Jim Brown played in only 9 NFL seasons. He won an amazing 8 rushing titles. Who took the rushing title in the only season that Jim Brown did not win it?
I'm striking out. I'm going to be 0 for 3.
Jim Taylor of Green Bay Packers.
Taylor.
Yeah. All right, so Mark, we got an email for you.
Yep.
This listener says, I guess this person's interested in a fund, says, how often do you have too much money pouring into your fund where you cannot deploy it fast enough? That's actually a very sophisticated and good question.
Well, it's sophisticated in that if you've never invested in a mortgage pool fund before, the way they work is that all new investments typically go into a holding account and don't earn any return or any interest for a period of time until the fund actually needs more money to fund another loan, yet another loan or a new loan. And so our experience has been that that time can be anywhere from a few days to up to 4 weeks. We've had to hold money sometimes for a little over a month before we were able to activate it, so to speak, is the term I tend to use, or deploy it into a new loan. Once it's deployed or activated, then you are now part of the fund, and you never get deactivated from the fund unless you want to redeem all or a portion of your investment. So initially, so in other words, to get into the fund, there's no guarantee that you can get in right away. And usually that's not a big deal because people take oftentimes months to make a decision to invest in something like, well, it's true. I mean, there's people that we've been corresponding back and forth on a semi-regular basis for over a year, and before they come in.
Yeah, they keep seeing the newsletters.
Right, absolutely.
Could have gotten 8%.
And actually several months is not unusual for someone to take to study it, think about it, rest on it, sleep on it, talk to a friend, get our newsletters, see that we're the real deal. Maybe talk to somebody else, and then all of a sudden, usually it's in response to yet another newsletter that we'll send out with a copy of maybe our monthly performance newsletter, and they'll say, what, I think it's time to give that a try, and then they'll send us a check, and it will go into our holding account, and then in a matter of days or weeks, then they will be finally in the fund and earning that yield, which has been a little over 8% for the last 2.5 years. And of course, past performance is no promise of a future result. You should always know that. But we designed the fund so that it would be paying out approximately between 8 and 8.5% on a regular basis, on a monthly basis. Actually, the 8% rate is an annualized rate. It doesn't pay
You're not paying
8% per
90.
month.
Yeah, you're not paying 96%.
We have monthly distributions in our fund. The fund's been paying on an annualized basis a little over 8% since its inception. We don't see that changing because we don't believe that the pricing of our loans is going to change. In fact, with short-term rates going up, if anything, our rates may trend up as well because again, we follow the market. We don't set the rates. The market sets the rates, and right now, market rates for private money loans in the Bay Area is right around 10%. And so we believe that that rate will allow us to pay out distributions of a little over 8% after costs and fees.
And you've actually had a number of your existing fund investors, me being one of them, actually add to their investment.
Well, it's funny because we have about 40% of our members have increased their investment, and about half of those have increased it several times over. So it's not unusual.
Well, they test the waters.
Right.
Yeah.
You open up an account with the minimum opening investment, and then you added that over time. So yeah, it's nice. It's one of the differences between a mortgage pool fund and investing in an individual note is that in an individual note you have to fund it when the loan is ready to fund, and then you normally cannot add to it or redeem it until the borrower actually pays off the loan. So although some people do prefer, people who are seasoned note investors, they know how note investing works and they like it, and they're in control of the note, and they know who the borrower is and where the property is, and they like that aspect of it. But it's not. There's a lot of competition for individual notes by people who are seasoned note investors. Mortgage pool funds, on the other hand, you have that flexibility where you can add to your account, you can decide to take distributions or not take distributions if you want to get an even boosted yield by compounding. Our compound investors are getting about 8.5% due to the wonderful effects of compounding. So again, there's a lot of flexibility, and again, for more information, you should just contact us. Our website is pacificmoneyfund.com.
Quick question: do you have a loan loss reserve?
We do. It's about 25% of assets under management is our loan loss reserve, and it's there in case. I'm sorry, 1/4%.
Yeah, I'm going. Oh, wait a minute here.
Yeah, the 25 was correct. I misplaced
The
it in
decimal
my
point.
mind. The decimal point. So 0.25% is what we fund our loan loss reserve.
So in theory, if 10 years goes by, you'd have an extra 2.5% in the fund to cover any potential.
Well, and we can adjust that. Loan loss reserves. Every fund manages their mortgage fund differently, and there are reasons not to allow the fund. In fact, the auditors don't like it when it gets too large. So again, there's nuances and best practices when it comes to things like how much is accrued for your annual expenses and how much do you set aside for a loan loss reserve. So
Okay, we have a quick minute.
Yeah.
Give us a quick update of any deal of the week.
So we had a great deal this week. In fact, it's funny that we talked about these bridge loans that we do, and we did another one for about $1.5 million this week, where it was a gentleman in San Francisco, family. They wanted to buy a target property first before they sold the home that they're in, and they needed a loan to 100% of the purchase price they needed to borrow, but they had equity in their existing home, so we did what's called cross-collateralized both properties, the property they were buying and the property that they own. And so our loan was like 65% loan to value between the equity and the two properties, but we were providing him basically 100% of the purchase price. And it was a $1.5 million transaction. And what was different about this loan is that this guy was so thrilled that we existed and that he had no idea that there were companies like ours out there, because no bank in the country would do this loan.
Yeah.
They just don't. They would never ever do it for reasons that we don't have enough time to explain. But he's now an advocate for the company. He's already referred a couple of new clients to us, and I just really appreciate it when someone doesn't, grind us and go, "Oh my God, I can't believe you're charging me 10% interest for this. It's usury." And it's really unfortunate that there are people out there that believe that, but it's
very,
really
very happy customer.
very refreshing to get someone who's just thrilled that we helped him buy his dream home.
All right, that's Pacific Private Money, pacificmoneyfund.com. All right, thought for the day. Just remember, when you go into court, you're putting yourself in the hands of 12 people who weren't smart enough to get out of jury duty.
That's right.
And light travels faster than sound. That's why some people appear bright until you hear them speak. Boy, is that the truth. Tune in next week to the Best of Investing. We're going to be giving away more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. Excellent. Mr. Smithers.
All right, well, we cobbled that one together pretty good.
We
Thank
did.
you, Kramer.
Glad